glad you guys could take some time out of your holiday weekend and visit with us. I have to say this is one of my favorite things to do is these summits. So welcome to today's class. We're going to kick off right now. Let's get going. All right, today's demonstration is designed to instruct you on MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. Okay. I do want to take a second to recognize our official sponsor, Stocks and Commodities, for registering today. As long as you opted in for it, you're going to get a free copy of them. Great magazine, fantastic. If you don't have a subscription, I'd recommend you get one. And one of the things that's pretty cool about what they do with us is if you spend $300 or more, you get a complimentary 2-year subscription to Stocks and Commodities magazine. So let's go ahead and jump into our first speaker today, Steve Bigalow. Steve Bigalow is a personal friend of mine. We've been working together for, I think, 4 or 5 years now. And, we spent a lot of time kind of taking his patterns and getting them coded out and into the MetaStock programming language and the programming environment. What I want to do right now and right away is, I want to thank everybody for coming out, and I want to thank Steve for kind of being an important part of our MetaStock family over the years. He's a great educator and somebody that we really enjoy doing business with. So I'm going to get out of his way. We're going to go ahead and turn the time over to him. Let me kind of get him ready for you. Awesome. Is there anything you would like to add to your introduction?
Not that I know of. By this time, I can't imagine anybody would want to know anything more about me than what they already know.
Well, I'm going to go ahead and let you kick it off then. Thanks for coming, Steve.
All right, thank you. Let me see if I can get the questions answered. First thing I always ask is, how many people have seen any of my sessions before? That gives me an idea of how fast or how in-depth go on each screen. All right. All right, looks like the majority have. All right, well, good. That means, and anybody that, if we go too fast, I guess, Jeff, this is all being recorded. They can get a,
yes.
Get a recording of it.
Yeah, we'll archive this up. It's a lot of video, but we'll have it up early next week or mid-next week.
Okay, great. All right. Well, what my session is going to be is what we call the triple T trading, the unfair advantage. And the reason we call it an unfair advantage is because most people are taught either how to invest by Wall Street, which is you buy good companies with good management and good growth, blah, blah, blah. That does not make, that is not what makes prices move. It's the perception of investor sentiment that makes prices move. So there are 12 major signals. When I started using candlesticks, I hate to think how many years ago, 4 decades ago, there was about 50 or 60 signals, and I learned every single one of them because I was greedy enough that I wanted to make money whenever I saw the opportunity. But through the years, what I've discovered is that there's only 12 major signals. And what are the signals? Basically, the Japanese rice traders took what is known as bar charts and did a very simple construct of them. This is where it opens, and this is where it closes. That creates a bullish candle. If it opens here and closes below where it opens, it creates a dark candle. That doesn't necessarily mean the price was up or down on the day. It just tells you what happened after the open. So this is what should bring everybody back to the very simple concept of candlestick analysis. It's basically the accumulative knowledge of everybody buying and selling during a specific time frame. And I don't know whether you can see my cursor yet. I hope so. And that works on any time frame. whether you're a long-term trader using a combination of the daily, weekly, monthly chart, or whether you're a swing trader or a day trader using the 1 minute, 3 minute, 10-minute combination. I used to trade the E-minis off the one minute, 3 minute, 10-minute combination. Right now, I use a swing trade stocks, but I'll day trade / swing trade commodities during the day. So these are the 12 major signals. And through the years, I've discovered that a lot of people have candlestick charts on their screen. They just didn't know what they meant, which doesn't do you very much good. And I always equate that to the story of the young Indian that left the Indian reservation because he went to Harvard, graduated top of his class, went straight to Wall Street, was making millions of bucks. When the chiefs called him back and said, "We need you to be chief of the tribe," and his heritage was much stronger than his will to make money, so he came back. But on the first day he was back at the reservation, everybody filed into his teepee, and their first question was, "How much wood do we collect for the winter?" And he had absolutely no idea. He said, "Give me an hour, come back in an hour, and I'll have an answer." And as soon as they filed out of this teepee, he called up the local weather station and said, "Hey, what do your indicators look like for the winter?" And they said, "Oh, it's going to be about the same as last year." And so when everybody came back in, he goes, "Collect the same amount of wood as last year, but collect an extra 2 weeks just to be safe." So they did. A few days later, just to be safe, he called up the weather station and said, "All right, your indicator's still good for the winter." And they said, "Oh, it's going to be a little bit colder than we thought." He goes, "Oh man!" So he called everybody back in and said, "Go out and get another 2 weeks worth of wood." So they started grumbling, but they did. A few days later, just to be safe, he said, "Your indicator's still all right?" And they go, "No, it's going to be a little bit colder than we thought." And he goes, "Oh man!" So he called everybody back in and said, "Hey, go out and get 6 weeks worth of wood so we don't have to keep going through this." So they grumbled, and they did. So once again, just to be safe, he called the weather station and said, your indicator's still all right?" And they go, "Oh no, we're going to have one of the worst winters we've ever had." And the young chief said, "What the hell is wrong with your computer indicators? You can't get anything right." And they go, "Oh, we don't use computer indicators. We watch the Indians. The more wood they collect, the colder the winter is going to be. So if you don't know what your signals are telling you and where you're getting the information from, it doesn't really do you any good." So here are the 12 major signals. And what I've discovered through the years is because candlesticks are created by the most basic and consistent indicator in the world, which is human emotions, that I went from being one of the worst investors in the world, which unfortunately I started out as a stockbroker, so that left a clientele high and dry. But everybody says, well, if you've got something that you can expect 70% winners, what else can you expect? You can also expect 30% losers. And this is where a lot of investors don't click in correctly, that if you've got losers, you have to know what to do with the losers and when, just as well as finding the winners. So if we can find concepts or techniques that create, instead of 30% losers, we move it down to 28.2% losers, or 27.9 or 29.1, it doesn't matter. The more we can decrease our losing percentages, obviously the greater our winning percentage, and it doesn't take very much percentage difference to really compound your returns. So with that, we can use very simple and effective stop loss procedures, and this is one of the things that I've learned and through the years, that I've heard every major money manager in the world tell you to cut your losses short and let your profits run, but in 40 some odd years, I've never heard a single one of them tell you how you cut your losses short and let your profits run. Candlesticks make it very simple. So I've done a video showing candlestick signals and patterns quantified, which we've got incorporated into MetaStock scanning techniques to find them. So we also use some confirming indicators with the signals, and Our most important one is the T-line. This is where the triple threat, the triple T comes from. And the T-line is the 8 exponential moving average. And it's called the T-line because it's what we call the trigger line. And very simply stated, if you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. You can have other combinations where you can have a close below the T-line but not with a candlestick reversal signal, or you could have a potential candlestick reversal signal, but if you don't close below the T-line, it doesn't become effective until you see that close below the T-line. On the other side, if you see a candlestick sell signal and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. So again, the signals at the T-line make very effective trading. If I see that there's a signal being created and they close above the T-line, I can stay in as long as it doesn't close below the T-line. Or we've got some very simple trading patterns like the fry pan bottom. It looks like a big rounding fry pan bottom, but notice what's happened once they started this uptrend. They couldn't close this back below the T-line. And notice where the breakout point is. And this is what we call a Doji Sandwich. This is one of the very high probability moves created by human nature. If you see a doji, and there's a very simple rule of the doji, it's going to move in the direction of how they traded after a doji. So if this is a big bullish day and a doji, and they open up positive, we can expect another big bullish day. And if we can expect another big bullish day, that's telling us that they're going through this level we want to be buying. And we also have what we call convergence analysis. And convergence analysis is that if we can add as many elements to our chart that improve the probabilities of being in the right trade at the right time, the more we can add to our analysis, the higher the probability we're going to be in the right trade at the right time. So there's our bullish harami, which tells us, which in the Western terminology is called the inside day. And that tells us pretty much that the selling has stopped. And notice where the selling has stopped. Right smack dab on the 200-day moving average. So the major advantage that we have with candlestick analysis is that we can see immediately what's going on in investor sentiment at important technical levels. Somebody asked me not too long ago, how many days does it take for you to confirm there's been a trend reversal? And the answer is 0. All we have to do is see a candlestick signal confirmed, and we're buying immediately, which does two things for us. Gets us in early, obviously, and secondly, if it's a failed trade, it gets us out very quickly, so our losses are very small, and then our gains are very big. But notice what was happening here. Bullish harami right smack dab off the 200-day moving average, followed by a second bullish harami, and then there's our Doji Sandwich closing above the T-line, and we have a very simple analysis of the Doji Sandwich. When you see a Doji Sandwich, especially coming out of the oversold condition, there's going to be more upside. So my overbought, I should probably go back here a little bit. The moving averages that I have on my charts is the 200-day moving average. This is the red, that's simple. The 50-day simple moving average, and the gray line is the 20-day simple moving average. And the reason we have these on our charts is because every major money manager around the world uses those moving averages to make their decisions about their portfolio. The black line is our T-line. Very simple. If we see a buy signal and a close above the T-line, we stay long until we see a sell signal and a close below the T-line. I should add in here, there's one caveat to that, and that is the further away you move from the T-line, the higher the probability they're going to come back and test it. So if you've moved away from the T-line too far and you see a sell signal, get ready to take profits because they're probably coming back down at least to test the T-line. At that point, you can make another decision if it supports at the T-line to buy back in on what we would call a J-hook pattern. Does it mean you take action only at the end of the day since you are deciding based on closing price? Most of the time, yes. There are different times when you will we'll close out a position. For example, let's say we saw dojis right here, and we know the simple rule of doji, that it's going to move in the direction of how they open it after a doji. But if they had opened it lower the next day, we would have closed it out because it would be confirming a sell signal and trading back below the T line. But we go into that. We do stop loss classes, and we go into that type of things. Is there a list of probabilities of success? Michael, no. Michael's question is there a list of probabilities of the success of the 12 major signals? The answer is no. All you can assume is that if we're still looking at the candlestick signals after 400 years, which is when the Japanese rice traders started developing it, there's a very simple rule on Wall Street that if something doesn't work, it doesn't stay around. Well, candlestick signals is the oldest trading technique in the world, and it's still around. And it's basically because it's got one very simple continuing factor, that you're using human emotions. And I always tell people, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick signals are just a graphic depiction of what's going on in investor sentiment. What about the close below the T line in early December? For that, you got to look at all these in right here. That was a doji, so that would have told me on an indecisive day just below the T line, and I would give it one more day. Or if I closed it out, I'd be ready to buy it back if it closed right back up above the T line. Why aren't you stopped out after the blue arrow? David, a lot of these are kind of just illustrations. The green is the 3 T line. That's the 3 exponential moving average, and that is used when you start moving too far away from the T line. The 12 major signals work intraday. They work at all time frames on a monthly chart or a minute chart. So also I use stochastics, and they're very simple. If you see a candlestick buy signal in the oversold condition, and my stochastics are 1233, that if you see a candlestick buy signal in the oversold condition, the probabilities are high probability that you're in a reversal. The T line is the 8 exponential moving average. So again, if I see that doji rule, the Doji Sandwich, and we're sitting right here at a resistance level, and we're coming out of a fry pan. Now, I just said that you're looking for a candlestick buy signal in the oversold condition. That works differently on a pattern. If you see a pattern getting ready to break out, it's usually going to occur when your stochastics are in the overbought condition. But if I'm sitting here at a resistance level, and I've got a Doji Sandwich setup, makes it very simple. If they start trading this positive, it's telling me that we're going to have a Doji Sandwich, so day 1 and day 3 are going to be approximately the same. That pretty much tells me the 50 is not acting as resistance. I want to be a buyer at that point. Veronica, it's when you see a confirmation. If this was the signal and it opened positive the next day, I'd be buying the next day. If you don't know when there might be a close below the T line, how do you know how much to bet on the breakout above the T line? Oh, Tom, I don't understand that question. Is it always true for all time frames? Yes. Yeah, if I missed your question, I'll try to get done fast enough before the end of the hour to answer any questions. So if I see there's my signal, a close above the T line. If I probably wouldn't be buying here, but I would definitely be buying here, because what's this telling me? Not only do I have a buy signal and a close above the T line, now I've gapped up through the resistance level. That's telling me I'm in the right place at the right time. Or just observe the obvious. The obvious is that prices move away from moving averages, but when they come back to the moving average, the major moving averages act like magnets. Because if you're a major institution and you're looking to buy this stock and you see it drifting back, where do you think you're going to buy it? if you see it support here at the 50. And we can see immediately whether the buyers are coming in at that point. Maybe, let's see, is everybody having a hard time seeing the cursor? Mark, the T-line is the 8 exponential moving average, the trigger line. If you see a candlestick buy signal and a close above the T-line, you stay long until you see a candlestick sell signal and a close back below the T-line. However, notice what was happening here. You're starting to move away. We've got some very simple rules. It shouldn't come back down through the previous day's open, but that's a whole different concept. Once again, if you start seeing buy signals, we see little dojis. The dojis is where it opens and closes at the same level or same price, and then it closes above the T-line. What's this whole information telling you? You're in the oversold area, you're on a support level, and they're closing above the T-line. It's time to be buying. The 3T, yes, is that light green. That's the 3 exponential moving average. This can be applied to options. You're not buying options based upon an option price. You're buying options based upon the stock. The options are just a method of buying that stock. So anyways, if I see a bullish engulfing signal followed by a gap up, everybody usually asks, what do you think, where's your target? Well, my target is usually the next major resistance level. And what do we see up here? Kind of a spinning top with a gap down, telling me they are failing at the 50. It also tells me I can go short until I see a candlestick buy signal confirmed. That's where I'm probably covering my short positions. The 3T line is the 3 exponential moving average. Are you buying at the high of a candle? No, I'm usually buying on the open after the a bullish candle confirms. Same scenario on the sell side. There's your big bearish and belt hold bearish engulfing signal, and then it closed below the T line. If it opens and starts trading down, what's that telling me? That these sell signals up here tell me to start taking or going short until I see a candlestick buy signal and a close back up above the T line. Again, the dojis at the T-line make it very simple. If I see a doji right here at the T-line, and the next day they trade positive, start trading positive, it tells me they're going to close above the T-line. I want to be a buyer. The T-line also acts as another method, which we call the T-line crunch. Notice how they couldn't trade this or close this back below the T-line, and they kept crunching it right back up into the resistance level. This level right here and the 50-day moving average. And then notice what they did, a little doji type day at the 50 when they opened up positive the next day. Again, we've got that Doji Sandwich high probability trade setup, but if it opens positive, what's it telling us? One, that this day right here and this day right here are probably going to be the same, and two, they're not resisting at this level. We're buying immediately, because what do you think everybody's watching? To see whether they're going to get through the 50-day moving average or not. What are your triggers to get out of the losing trades? Very simple. If I see a candlestick buy signal, what do I expect the next day to trade positive? The Japanese rice traders made it very simple. If this was the candle that told you the bulls were in control, where should it not close? It shouldn't close more than halfway down that candle, because that would tell you the bears are still in control. You get out of that position immediately. A doji sandwich is a big bullish day, a doji, and a simple rule of a doji, it's going to move in the direction of how they open it after a doji. If they open it positive, you're buying immediately, because this candle right here and this candle right here are usually going to be the same, with the doji in between making your doji sandwich. Let's see. All right, I'm going to try to go through these quickly. If one doji means indecision, a series of doji means greater indecision. So where do most people sell? This is one of the basic concepts of candlestick analysis. Most people panic sell at the bottom. We can see that graphically. Where do most people buy? They buy exuberantly at the top. So if one doji means indecision, a series of doji means greater indecision, look for a close above the T-line, because the longer this indecision is, the more powerful the next move is going to be. Dojis, close above the T-line, And notice the doji was right here on the T-line. The next day they open up positive. We're buying immediately. The more dojis you see, the more compelling that this indecision is now. We can see what their decision was. And how long do we stay long? As long as it doesn't close below the T-line. Fry pan bottoms are one of the patterns. There's 12 major signals. There's about 6 patterns. A fry pan bottom looks like a fry pan bottom, a slow rounding pattern. And remember, we're looking at buy signals when the stochastics are in the oversold area. But usually when a pattern is breaking out is when the stochastics are in the overbought area. And what tells us that there's exuberance coming back into this trade? Because notice a little buy signal here, and then they gap it through the resistance level, creates a very strong price move. When do we take profits? Up here. And I used to, this is one of the major aspects of candlestick analysis, is that it takes the emotions out of your trading. If I had this and I finally took profits up here, I wouldn't get back in because, boy, they're not going to trick me to get back in. But with candlestick analysis, you can see what patterns are usually created in human nature. And if they start buying this again, we've got a J-hook pattern, which is what we call the classic. The classic is a fry pan bottom. What do we expect coming out of a fry pan bottom? A very strong price move. What do we expect after a very strong price move? The potential of a J-hook pattern, which is profit taking, and then we can tell whether it's profit taking or a reversal based upon the nature of the signals. Gets indecisive and starts back up. If I closed out here, I'm not afraid to buy back here because that tells me that this wave right here is going to be essentially the same as this wave right here. And all the webinars I've seen, they only talk about stocks. Is this relevant? This candlestick analysis is relevant. You could be looking at a Forex chart. You could be looking at a bond chart. Candlestick signals are the graphic depiction of what's going on in investor sentiment no matter what you're trading. You can trade stocks, bonds, commodities, currencies, tulip bulbs. Candlestick analysis is merely the graphic depiction of what's going on in investor sentiment for any trading entity. There's your fry pan bottom. There's our expectation, a very strong price move. So anytime I see this big fry pan bottom setting up, I'm looking to start buying over here because as you can see in the fry pan bottom, there's nothing here that you could really want to trade. But we know when it comes out of this area, our expectation is a very strong price move to the upside. So we can be buying calls or the stock right here, knowing that if we've broken out of fry pan bottom, 2 things are going to happen. We're going to have a very strong price move. Or if it fails, closing back below the T-line, we're right back out of the trade. My stochastics are slow stochastics. And stochastics are not anything that are highly relevant. It basically tells you where you are. Obviously, a candlestick buy signal in the overbought condition doesn't mean anything. Or a candlestick sell signal in the oversold condition doesn't mean anything. We're looking for the candlestick buy signal in the oversold and the candlestick sell signal in the overbought. Yes, a fry pan bottom is, if this failed here, I wouldn't leave the chart. I'd see if it's doing a little cup and handle after that. Dumpling top, yes, is the opposite. So I'm looking for breakout situations. This is the ultimate timing, that if you can see that there's candlestick buy signals, this is what we call your best friend, which is one of the major signal patterns that we have on the MetaStock scans, is a little doji followed by a gap up. That's your best friend. That's not only produces a high probability of being in a profitable trade, but a very strong profitable trade. And if we can see that it's breaking this little downtrending channel, it adds more compelling factors that there's going to be a very strong price move. So anytime I see something like this, where it's starting to break out, I'm buying, and I'll stay long as it stays above the T-line. This is what we expect coming out of a fry pan bottom. There's a very strong price move. And then we know when to sell. Again, the further away you move from the T-line, the higher the probability it's going to come back and test it. When it starts getting up here in the overbought condition, I use one very simple rule. I put my stop at the previous day's open, because if they can come back down through there the next day, that tells me the the bears are in control, and I can pretty much calculate where they're going to bring the price back to. And there's the opposite of the fry pan, is called the dumpling top. With expectations, you're going to have a very strong price move to the downside. So anytime I see this, I can be shorting, knowing that I'm in a downtrend, and then there's another dumpling top. And so this creates a very good trade setup. Notice what we have right here at the support level. A doji. And what's our simple rule of a doji? The price is usually going to move in the direction of how they open it after a doji. If they open it positive, I'm out of any short positions. I'm ready to go long, because what's that telling me? That I've got a double bottom setting up. On the other hand, if it opens lower, it tells me I'm going lower. I've got a Doji Sandwich set up. Tells me this level is not acting as support. I've probably got a lot more downside. There is a fry pan bottom just before. Oh, I don't know where that is. All right. So again, if this opened lower, it tells me the support area is now not acting as support. Here's one of the ones. This is a kind of a derivative of fry pan bottom, is a slow curve. Anytime I see this slow curve, high probability that if they break out, this is where I've made most of my money through the years, is buying stock and or calls right at this level or right at this level, because this is my expectation, a big price move. And if it fails, closing back below the T-line, I'm back out of the trade. How does the doji apply in Forex? See, you usually don't, well, you can get a doji in Forex. You usually can't get gaps in Forex because of the continuous trading. But that's where you decide what type of time frame you want to use, whether it's a 15-minute chart, a hourly chart that shows you the different patterns. The J-hook pattern, again, remember the classic fry pan bottom, strong price move, J-hook pattern, time to take profits, time to buy back in, because wave 1 and wave 3 will usually be the same. So if I see something like this, I'm starting to buy, even if I miss this move. I know that if I'm starting to buy here based on a J-hook, that I can expect to move along that magnitude. You got a gap in the Swiss franc, that's right. So again, we've quantified them. Here's one of your strongest signals. Anytime I see a doji in the oversold condition and they gap it up the next day, that's called your best friend, because not only is it an extremely high probability that you're in an uptrend, it's an extremely high probability you're going to be in a strong uptrend. Your stochastics should both K and D below 20. Again, John, the stochastics are only telling you where you are in a trend. Obviously, you don't want a buy signal right here. Doesn't mean all that much. A buy signal down in this area, I mean, you'd like to see it below 20. But remember, the first criteria that I work off of is what is the signal, and then where is it occurring, and then where is it occurring as far as the T-line. Yes, guideline confirmation, yep. William percent R is a lagging indicator. Stochastics is just a slightly lagging indicator. And again, we're not using indicators to buy or sell. We're using the signals to tell us where they're occurring and when to buy. Some of these are filled in, and I don't know whether we've changed them for MetaStock or not. This one, this green candle filled in, is because it opened here and closed here, which should be a red candle, but they had it formulated that it was still a positive day. But I hope we've moved it back to where this is a red candle, because remember, the red candle is telling you something. So pattern confirmation is, again, from some MetaStock scanning, there's your best friend, that doji gap up, telling you that wave 3 is now in progress. Gap up. There's our wave 1. We can expect this wave to be the same magnitude as this wave. So even if I miss this move, and I see a best friend signal near the oversold area and gaps up above the T-line, not only do I expect a strong price move, but I can also calculate that it's a J-hook pattern. So this is what we call the blue ice failure. And a blue ice failure is when it comes down through a resist or a support level, it's failed. If it comes back up and hits this resistance level and fails again, we know it's going to come back down to the next lower support level. And that phrase was coined by my late friend Dave Elliott of Wall Street Teachers, because basically somebody's fallen through the ice, they come up trying to find the hole, they can't find it, they drown, they go back to the bottom of the pond. And I was always a great asset to him. When he was giving his presentation, I would interrupt and say, well, how do you catch a polar bear? And the way you catch a polar bear is you cut a big hole in the ice, and then you take a can of peas and you spread that can of peas around the edge of the hole, and when the polar bear comes down to take a pea, you kick him in the ice hole. Wasn't a technical analysis, but I remembered blue ice failure. Also, if J-hook pattern, we can see our inverted hammers and dojis right smack dab off the 50, closing back up above the T-line. And then there's your Doji Sandwich. And what do we expect after a Doji Sandwich? More upside. So this is a perfect setup for a J-hook pattern, that if I miss this move, I know this move right here should be the same magnitude as this move right here. This just is a PG. So also, candlestick signals tell you when to take profits. Remember our truism. One of the truisms of candlesticks is that the further away you move from the T-line, the higher the probability it's going to come back and test it. So if I start seeing potential sell signals, what's our simple rule of a doji? It's going to move in the direction of how they open it after a doji. I'm closing right here, because where's my next target likely? Back to the T-line. And where are our stochastics? Up here in the overbought condition. This is our breakout. Notice how this is just a high profit, high probability trade setup. Your slow curve, and it breaks out through the resistance level. We stay long until we see a sell signal. So here's our fry pan bottom, which we were buying right in here on the breakout. And so when did we know when to take profits? Well, look where we are on this day. We're starting to move away from the T-line. Then the next day they open it, trade off a little bit. That could have meant they were starting to take it back. So how do we calculate? If we had this go all the way up here and then came all the way back down here, we would have lost a lot of our profitability. So if I'm a swing trader, which I am, and I'm owning this, what are the things that are telling me to start looking for profit taking? Now, I've moved a huge way away from the T-line. So all I do is move to my 10-minute chart. My 10-minute chart, the next day when it opened, it gapped up, but then came back down through the T-line. We took profits. But notice what happened. It came right back up above the T-line. We bought back in. Why would we buy back in on a trade that was way away from the T-line? Because what is our expectation of a fry pan bottom? A very strong price move. So we're buying back, and then the next day when they opened it and started trading it lower, we took our profits. So it basically tells you when to get in. If this is exuberance, it tells you when to get in and tells you when to start looking to get off or get out at the top. So we got out up in this area versus getting out up in here. Anytime I see this is our good buy, there's our slow curve breakout, and then they gap up and do a doji, probably with it moving up that fast, I just got some simple rules. I'll take half the position off because I'm on the overbought condition and I've got some gap ups or a gap up in the overbought condition and doing a doji. If it goes higher, I'm still making money on my half position. I can sleep with that. On the other hand, if it opens lower, I close out the other half. I can sleep with the fact that most of my profits were somewhere right in this range. And here's the stop loss type things. If this was a buy and I'm starting buying here, if this was a signal that told me it was time to buy, where should it not trade? It shouldn't trade back below this level because that tells me two things. One, that this potential buy signal has been negated, and two, they never could get it back up above the T-line. And a lot of people say, do you buy going into earnings? Remember, the candlestick signals are the accumulative knowledge of everybody buying and selling during a particular time frame. So if they all know that earnings are coming out tonight and they're still buying going into the close, I'm buying, because that tells me that probably people that are a lot smarter than me are going to be are buying going into the close. And so we made some very good money. Bought the calls here at 51 cents, sold them out at 3.80. Or right before the close, they're selling it off. We're buying the puts. This one a while back, Keurig gapped down after that. How do you differentiate slow curve breakout from a fry pan bottom? You don't have to. They both have the same results. And usually a slow curve will occur during the uptrend. It just is a pullback in the uptrend, whereas a fry pan bottom is usually down at the bottom of a trend and usually a little bit longer. So again, there's earnings on Netflix a while back. We were buying the calls going into the close because somebody a lot smarter than us was buying, knowing that the earnings were coming out that afternoon. So, and when to take profits again. If this is where we're buying based on a breakout, there's your left-right combo, and a left-right combo is another one of the MetaStock scan indicators that we look for, and that's a doji followed by a bullish engulfing signal. Remember, a doji represents indecision. A bullish engulfing signal tells you exactly what your decision is. And then up here, notice where we are from the T-line. We're in the overbought condition, and we're a heck of a long ways from the T-line. That's when we flip to our 10-minute chart. Or if we got a big price move like this on the breakout, and that was a big percentage move, what do? We just flip to our 10-minute chart. Makes it very simple. If they start closing back below the T-line, we take our profits. We can always buy back when it comes back up through the T-line. Do you look for signals within a trend? You can, because a signal within a trend might be creating a pattern. I don't use Fibonacci extensions and retracements as an indicator to make my decision. I look at the signals, and then if their signal is occurring someplace where there's no other indicator, like a moving average or a trend line, then I'll throw the Fibonacci number on to see if that's where everybody's starting to buy. Do you not consider the options are more expensive before earnings? Sherry, I'm buying the options based upon what my probabilities are, based upon what they're doing right before the earnings. So, are there times where I get nipped or get slammed on bad earnings? Definitely. But for every time I get hit on a bad earnings situation, I probably have 4, 5, 6 times that amount as far as good trades. Again, all because of one simple concept. The candlestick signals are the accumulative knowledge of everybody buying and selling during a particular time frame. Do you buy at the money options, David? When we do our option trainings, it's based on the math. Which ones make the which trade option trade setup makes the most sense? In the money, at the money, or out of the money, depending on the chart pattern, and or depending on the time frame left, whether we do a debit spread or a credit spread. Are candlestick signals less reliable or short time frame? No. Again, there's still the accumulative knowledge of everybody buying and selling during a particular time frame. So on that last one, we were taking profits up here because that's what our 10-minute chart was telling us, that they were starting to take profits. And why would we start taking profits up here without a candlestick sell signal on a daily chart? Because notice where we are compared to the T-line. Not only had we broken out through this upward trend channel, but we were a heck of a long ways from the T-line. And what happens when you start getting big price moves? You get people coming in and taking profits. So they work on all time frames. Again, 1 minute. I usually trade commodities on a 10-minute as my bellwether, and then use the 5-minute and 1 minute as my scanning. How do we scan for signals in MetaStock? NG or NN Jeff will show you all that. So again, convergence technology. Where do we think where would it fail? Well, they did a shooting star failing right here at the 50. What's our analysis of this trend? We can see we're already in a downtrend. So from here, you've got a shooting star followed by a gap down with stochastic setting down. Where do you think your next target is? Well, we can be shorting on the basis that it's probably coming back down to the bottom of the trend channel. Do you have losing weeks? Oh yeah, I have losing weeks. But Anthony, here's the analysis. I'm not any great sage investor. I didn't come out of the chute knowing that that I was a great investor. I was the worst investor in the world. I know everybody thinks that, but I was the worst investor in the world. I was the one that was buying exuberantly at the top or panic selling at the bottom. And when I started learning what the charts were telling me, I reversed that. Now I make a very, very good living constantly. Do I have a bad week every now and then? Certainly do. But I usually pick it right back up in the next week because I'm using one very simple technique, and that is I'm just watching human emotions, which don't change. They haven't changed over the last 400 years. They're not going to change over the next 400 years. So if I'm trading the coffee charts, I'm taking profits because I'm starting to see sell signals, and I'm buying back here. So it works off the 10-minute chart, the daily chart. Again, there's our classic fry pan bottom. I can see what the patterns are. Again, there's only about 6 candlestick patterns and 12 signals, 6 longs and 6 shorts. What are the characteristics of these candlestick patterns? How do we recognize them on the chart? That's just visual. Everything's visual. You can see this is a fry pan bottom, and you can see this is a J-hook pattern. I can't pull up live charts right now, Pan K, because I'm on PowerPoint at this point. So you can analyze the trend. Basically, it all boils down to that if you can put all your stars in alignment, if you know which way the market is moving, if you know which way the sector is moving, then you can pick out the best stocks with the best chart patterns. You're putting everything in your favor. So if I see bullish harami right off the 200-day moving average on the Dow and it closes above the T-line, I'm staying long until I see that sell signal to close back below the T-line. I'm staying short until I see the buy signal. There's our morning star signal. And it starts back up again. I could do Forex. I just don't trade Forex. I trade currencies because I'd rather just trade one direction at a time. So if I'm trading a currency, I'm either buying the dollar or I'm selling the euro and not doing a combination. When do you use an option spread versus simple? Pan K, I usually use a spread when I'm getting closer to expiration because you want to be your maximum value on that spread is going to be at expiration date without any premium in either one of them. So we were analyzing the Dow. As you can see, the Dow is doing nothing for us, which also tells us something. We can analyze whether there's a trend or a non-trend in the market. When we know there's a non-trend, we know that we're trading a much shorter time frame, number one, and or we can, based upon the simple scans, we can be long positions and short positions at the same time. So right now, as we can see, the Dow has broken out of this wedge formation. It closed yesterday right on the T-line, but at the same time, notice what the NASDAQ is doing. It's still above the T-line, and this is one of the simple things that candlesticks provide for us. Yesterday, the NASDAQ was down. However, what it did above where it was opening. So that told us, even though it was down on the day, there were still buyers there. That gives us a whole different perspective of what to be looking for. And the breakout of our trend on the Dow, notice what type of pattern we had here, that little J-hook pattern. So that tells us we're probably in an up move that's keeping us out of this wedge formation. Do you have any recordings on how to set up charts for a beginner? Yes, we've got that. If I'm trading crude oil, this could be a 10-minute chart. This could be a daily. If I see the daily is moving with a Morningstar signal that we're probably in an uptrend, I'm trading that on the long side on an intraday basis. There's our left-right combo. And where did this occur? Right about the same level here, telling me there's probably a double bottom going on. If I'm trading the crude oil on a 10-minute chart, there's my slow curve breakout. I'm staying long. I'm taking profits here. So now what am I looking for? I'm looking for a fry pan bottom type pattern to see if it's starting to set up for that. If I'm buying a breakout like we did the other day on PBMD, do we buy here? Do we buy here? Do we buy here? When do you buy a breakout? Very simply, I can go to the 10-minute chart. The 10-minute chart's telling me they're still trading above the T-line. I can be buying here. I can still be buying here. What's this part of the chart telling me? Well, I may not want to buy right now. Let's see if it's going to stay above the T-line. I can be buying here. I can be buying here. Will it turn around after that? Could be, but I'm in a breakout situation on a daily chart, and the 10-minute chart tells me there's no selling going on. So at least I know when I'm buying right now that I'm not buying into a pullback that may be continuing. I'm buying something that's still showing they're trading higher. Do you always get huge moves like this on a candlestick breakout pattern? Definitely not. But it puts you in positions where the probabilities of being in these type of moves are much greater. Again, I was the worst investor in the world until candlesticks came along. Now all candlesticks do is it puts us in a graphic depiction of being in the right place at the right time. And candlesticks don't use anything more than one of the major consistent indicators in the world, and that's human emotions. So I think that's about all I got. Let me see what questions. Let me do a couple quick questions, and I think Jeff will tell you how to do some of the scanning. Do polar bear straight T line. You sell when the daily candlesticks tells you, yes, because that's what the indicators are telling us. If the candlestick signal or the pattern is, again, way from the T-line, then I'll flip to my 10-minute chart to see when it's time to sell. The moving averages, the 50, the 200, and the 20 are simple. The T-line and the 3 T-line are exponential. I don't consider volume unless it occurs. If you see a big volume day on a reversal day, that pretty much tells you that you've had a lot of sellers or a lot of people exchanging hands. What usually happens? Usually you're having the panic sellers sell into the smart money, or at the top you've got the exuberant buyers buying from the smart money. When do you buy a J-hook pattern? You can enter it just as it starts curling up, or you can enter it as it breaks out through the previous high. Depends on what your risk factor is. Parquet, I can't remember what Facebook. I think Facebook did break out of its range the last couple of days, but I can't. I haven't been a trader of Facebook because it just hasn't had a very exuberant chart or a great chart to trade. Let's see, volume. A lot of people say, well, I want to see the volume go up as the price goes up. Volume and price have absolutely nothing to do with each other. If you've got a stock that's moving up and nobody wants to sell it to you, people are going to pay up for it on small volume. Do you sell on the open on the next day? Todd, it depends on what the chart pattern or what the signal is telling me. If the next day I have a doji sitting right on the T-line and it opens lower, yes, I'm closing out the position on the open. If I had a doji followed by a big bearish candle today, if I didn't sell on the lower open, I'm definitely selling with it closing below the T-line. What chart periods are you using to scan and trade? Michael, because I'm a swing trader, I usually use the daily chart. If I'm day trading, I use the daily chart to tell me what the major direction is, and then I use the 10-minute chart as my bellwether for trading intraday. Uh, oh, Frank, there's the fry pan bottom, the cradle pattern, the scoop pattern, the belt hold signal. Say fry pan bottom, J hook, and there's another one. I can't think of it right off the top of my head. Um, can you tell the bubble bath joke? No, TD. That when I was growing up, I was so poor that the only time we had a bubble bath on a Saturday night is when we ate beans on Friday night. How do you only use the body of the? Do you only use the body to determine the candle length, or do you include the wick? No. Remember, the most important factor the Japanese rice traders are considering is the open and the close. So the body is your main factor, but the wicks also kind of add to the to that analysis. Yes, do the same long-term picks the same way. I might be using a weekly or a monthly chart to tell me the overall trend. Let's see, how much time do you need, Jeff, or have I used up all my time?
Yeah, we can. Now would be probably a good time to show
Okay, all right.
Candlestick product system and stuff like that. But
All
Steve,
right.
great job. Next time you'll have to tell the walk a mile in somebody else's shoes joke. That was a pretty good
Okay,
one too.
all right.
All right, cool, awesome. Well, I want to thank Steve real quick. Steve's been a great partner of us over the years, and we always spent a lot. We spent a lot of time getting this product ready for MetaStock, and a bunch of the questions that you guys have had about how easy it is to run the scans and can I use it on different countries and stuff like that. We're going to spend just a couple minutes just showing you how easy it is and kind of give you an idea of the tool itself. So. Several years ago, I think we got done about 3 years ago. We spent 2 or 3 years with Steve, kind of getting everything perfect. We got all of his explorations done, his expert advisor, his layout, and we ended up identifying on the charts themselves about 20 different patterns. And here's a list of them. We have your fry pan, your bullish belt hold, your bearish bolt hold, your dumpling tops, your cradles, your fry pan bottom. Anyway, here's the whole list of them. Don't have time to kind of go through all of them, but I do want to show you real quickly how easy this is to use on MetaStock. And we had a lot of questions during the event about pattern characteristics. How can we find the patterns? What are the characteristics of them? How easy it is to scan? Can I scan in different countries and that kind of stuff? So as Steve started his presentation, I ran a little bit of a scan today. And I'm going to open up what we call the MetaStock Power Console just to show you this real quick. The scans that you can run, we have them broken up into categories like Doji Dynamite, J-hook, CPS power signals, price patterns, and there's a couple that we built with Steve to kind of define an American universe. So those look for stocks that are like overbought or oversold and have a certain amount of volume and a certain price. So to run this scan, really, literally, all you have to do is decide which one you want to run. Now, I could go in and select 5 or 6 of them and just run all of them at the same time. I just do that. And then down under here, you're just going to select what markets you're interested in. So if you're interested in optionable stocks, that's what I ran it today against, but you could also come in here and somebody asked, well, can I use this in my market? We cover about 182 exchanges that you could run this against. So again, you're going to be able to find the markets and the signals that you want just by selecting which ones that you want here. So we're not going to run the scan. It probably takes, it took about 5 minutes for me to run the scan through all of the optionable stocks while Steve was getting started today. It's about 4,300 instruments. It's a very effective way to scan the market. And like a lot of other scanning tools, it doesn't, you don't have to define the list that you want to scan against beforehand. It's all there. You just basically say, I want this list, I want this list, I want this list. And they have some really good lists that are available. Like I could just do the ETFs if I wanted to. I could go and just do Forex. I could just go to the New York Stock Exchange. Whatever you want to do in that respect. When it comes back, what you're going to get is a report. And that report's just going to list the patterns that were available. Where is my report? Oh, it's right over here. So here, this one is the report for the power signals. And so you've got your bearish flutter kick, your bullish header kick, and it's just a list. I can save this list, or I can open the chart right here on the chart if I want to. If I click on Open Chart, it's going to open the chart for me. If I click on Save List, this will allow me to save a list that I can then go and arrow one at a time through the charts on. Once you open up those charts, and again, I'm not going to run this scan today, but this is one that came up for yesterday. And you notice we have the bearish kicker right here on the top. We've got the bullish kicker here. All of these patterns are automatically identified and labeled on the chart for you. And in addition, we had a lot of questions of saying, okay, what are the characteristics of this? And we spelled that out here in our commentary. We're saying, okay, specific criteria that created this alert are this and this. Tell you a little bit what to do with it, and kind of help you understand the patterns. One of the nice things about our expert advisor, and I'm going to move it to this bearish kicker, is we can kind of tell you what the pattern is, and we can kind of give you some ideas on how to trade them. So, and if you have a bunch, with the example of this bullish kicker that we were looking at about a week ago, we've actually got enhancements. So we kind of tell you what to look for to find the very best one out of the ones that are already identified for you. So let me go back. We don't have a lot of time, but let me go back to the patterns that we've identified. Here's that complete list for you. It's a fantastic product. It's been very, very popular since we released it, and I'd recommend that you add it to your trading arsenal. Let's go ahead and kind of move on a little bit. For those of you that come to the summit today, there's a couple of action packages that include the Steve Bigalow Candlestick Profit Systems. We'll give you 3 months of Zenith, 3 months of real-time news and data, and 3 months of MetaStock RT. We're also going to give you a huge discount on Steve Bigalow's Candle Profit System. I'm going to include some bonus free pre-filter scans that Steve and I wrote after the product came out. And if you do that, you're actually going to get 2 years of stocks and commodities. Normally that would be over $1,000 for 3 months of MetaStock, the 2 years of stocks and commodities and candle profit systems, but it's $549 if you do it today. To do that, you can call 1-800-882-3040. We also have an end-of-day version of this offer as well, which includes 3 months of MetaStock end of day, or I should say MetaStock DC. It updates every hour. It includes 3 months of data. It includes Steve Bigalow's Candle Profit Systems, the pre-filter scans, and then 2 years of stocks and commodities is $358. Now, if you already own MetaStock, I know a lot of you already have MetaStock in the audience, you can pick up just Steve's add-on at a $100 discount. It's $299. It does come with a 30-day money-back guarantee, and I'll also throw in 2 years of stocks and commodities, and then the bonus pre-filter scans for that as well. Again, to take advantage of that, we have people that can kind of help you get set up. You just call 1-800-882-3040. Okay, all right. Moving along, I do want to say thank you to Stocks and Commodities. What a great magazine. We've been working with them for a number of years. You know, because you're here today, it's important to kind of continue that education. I believe in life you're getting better or you're getting worse, and Stocks and Commodities is a great way to do that. Okay. I do also want to say we are having our annual users conference at Snowbird this year, October 9th through 11th. Everything just got put up on our website this week. We are throwing out another offer. If you're interested in coming in and doing an in-person event with us, I'd recommend you do it. I just got back from Vegas, and they did a really, really good class. In fact, I saw our next speaker there, Steve Primo, and it was good to see him in person. But it's always so good to be able to go sit down with a group of traders and kind of really talk and learn. And I think the amount of education you get there is really, really good. So in any case, we're going to give you half price if you order today. And you can do that online or you can call in as well.